Hello everyone, today is Friday, March 11th, and this is your USA Gold Weekly Review and Outlook. I feel like we say it every week, but another crazy week in the books. This week mostly centered around the euro, so we're going to talk largely about that. But just a quick review of gold. Gold was actually largely flat after it was all said and done for the week. There's actually a decent amount of interrange volatility. Basically saw about 1240 on the low end and about 1280 on the high end. Currently trading right around 1260, which is basically where it started the week. Looking back to last week, and by the way, sorry we missed you last week. Pete was traveling, but basically from last week, middle of last week through now, we saw a pretty big rally in oil and a pretty big rally in stocks commensurate with that. Dow Jones is now trading above 17,000, oil close to $40 a barrel. But that said, moving to the euro and what happened in the eurozone this week, definitely the biggest story of the week. So just start us there, Pete. Big ECB meeting and
right.
Fired a bazooka, I guess. But yeah, jump in.
It was a pretty dovish policy move on the part of the ECB. 10 basis point cut to the refi rate, taking it to negative 0.40%. Also cut the bank deposit rate and the main refi rate. So 3 interest rates cut. One deeper into negative territory, the big one, obviously.
Right.
And then up the ante on the QE program by a third, from 60 billion euros a month to 80 billion euros a month moving forward. Yeah. So a big dovish move. Interestingly, though, during the press conference, the Mario Draghi said that he didn't anticipate having to cut interest rate further. And so the market sort of interpreted that as putting a floor under rates.
Right.
And the euro went from about 108.75 against the dollar to over 112.
Oh yeah, and you can see it, and we'll throw the graph up so you can see, down and then back up. It was just a really steep move, really quick, both directions, a lot of volatility there. But yeah, I think it points to, and what you're saying, is almost the loss of, really a loss of credibility in the central bank of here's what we're going to do, but the sense that the market has of, well, A, what is it going to do, or is it even going to do anything? And B, do they have any idea what they're doing?
Well, think about this. So earlier this week, they celebrated the 1-year anniversary of what I guess you could call the ECB's QE1. 700 billion euros spent in the last year. And what happened yesterday, and I think part of the reason that the ECB is kind of panicking at this point and did fire the bazooka, is they slashed their inflation forecast to 0.1% for 2016. And that's down from, it was 1% back in December, the last time they did a forecast. So just inflation expectations are cratering despite all they have done in the last year. And so they kind of had to go big, but then again, it raises the question, why would you put the floor under? Because I think once a central bank has reached the zero bound and gone below it, actually, having the credibility that they're prepared to cut it even further into negative territory is really a really important tool.
Well, it is. It's divergent ideas. On one hand, you're saying, look at how big we're going and look at how accommodating we're going to be, but this is it. And central banks' influence over markets is so heavily dependent on expectations and managing expectations. That's what they always say. And so here you do one thing, but then you set expectations in a completely different direction. You're essentially counteracting everything that you've done.
Right, and so we kind of kicked around yesterday a couple of ideas. Mario Draghi, pretty savvy central banker, not prone to mistakes in terms of messaging. So what was he thinking? If that was really his intent, to put a floor under rates, is it the reality that if you go much lower, you're going to crater the banking system? That could be it.
Yeah.
Obviously, the Bundesbank has been against going negative, and the German banking system is already arguably in trouble. So
look no further than Deutsche Bank.
Maybe a little bit of arm twisting by Jens Wiedmann as well.
It's possible, and that's a very important topic to cover briefly here, is just what it does mean to the banking system to have negative interest rates, because what a lot of the European banks are doing, where we're seeing there and Japan are where you're seeing the majority of negative interest rates, the banks are actually making up the difference, because they're worried that if they really do cut the deposit rate below zero, that everybody's going to flee the bank. And so now the reason the bank stocks are getting hit so hard is because they're essentially absorbing this cost of negative interest rates rather than passing it on to the depositors for fear of an actual bank run. And so now the bank stocks are getting clobbered, so you're creating another crisis in banking values.
They're weighing earnings against the possibility of bank run.
Exactly. And so, I mean, what a horrible position to be in as a banking system. And so,
especially as you look forward.
Exactly,
So if you look backwards and see that there's been just abysmal results, no success whatsoever in what they've done year to date, to go forward and say, well, gosh, where are they going to take the refi rate? Is it going to go to 1% below zero? I mean, who knows?
Well, yeah, they're basically saying to them, we will pay you to take our money and lend it, but I think what they're doing is they're taking the money and taking the differential to make up for the loss that they have, and the interest payments that they're having to make out to the depositors. It's so
bottom line, it is a really unstable system.
It is, and that is the underlying and most important takeaway from this. And I think that these big flashy numbers, big flashy headlines, they kind of go back to the original QEs and let's throw a ton of money at this and let's watch markets be all jubilant about it, but it's just not happening anymore. The traction of the QE policies and these interest rate policies, they're losing traction, and I think that that's the biggest takeaway from what happened in Europe this week. And I think it's going to be fascinating to watch as central banks kind of scramble, because this is not a good precedent to be set at all. And so then moving on, I kind of do want to touch on this too, as we've seen oil and stocks rallying recently. One thing that gold has shown, since the beginning of the year, has really been this negative correlation to stocks. But what I find so intriguing about that is that gold has been going up a lot when stocks have gone down. But when stocks have gone up, gold has very much held its head. And we've seen this over the last 2 weeks. Gold isn't like breaking out above 1250. I mean, we saw a couple flashes higher and so forth, but in the meanwhile, stocks have gone from 16 to 17,000, and oil's rallied from 30 to 40. And these were supposedly the big fuels to the gold bull market over the first few months of this year. So now you've removed that fuel, yet gold has shown no adverse impact.
In fact, it's at a 13-week high, today. I mean, overseas.
And I think that bodes extremely well for just the price performance of gold itself.
Actually, because 13-month high, not 13-week high.
Yeah, exactly right. So they're. But it's very fascinating to watch, because it does bode very well for gold in the simple context that very many, and as we get to the golden gong of the week this week, who's from Jeff Gundlach, even before I get to what he, the quote that we're going to use from him, he actually remarked that, when you look at negative interest rate policy, you look at the impact of stocks, basically that it's going to negatively impact stocks. And so you say, okay, well, what are the paths of least resistance? And if you agree that these policies and their efficacy, sorry, couldn't get the word out, but that you look at that and you look at how stocks are and you look at the path of least resistance being lower, and how gold has responded when moving lower, and the negative correlation there, but that it is not offering it on the other side. It's just a very strong fundamental picture for the gold market, and also speaks a great deal to the demand that we're seeing for gold, both here in the United States with the private investors, but globally. And I think it's definitely something worth watching. As we look to next week,
Fed meets. I think the market is certainly anticipating that the Fed is going to hold steady next week. I think that there is a chance, and what's interesting is when with the ECB move yesterday and the euro's reaction to it, so the much higher euro, it actually kind of gives Fed a little bit of room to maybe do something. But I still think that they hold steady at this point. Right. I don't think the market can withstand another 25 basis point rate hike. And I think at this point they're getting more policy divergence than they bargained for, with the ECB going very dovish and likely the BOJ going more dovish as well.
And I concur that divergence is going to be the biggest headwind to their ability to do what they purport that they want to do. So we'll be keeping an eye on that. We'll definitely be covering that next week as well. So now moving on to the Golden Gong, like I said, Jeff Gunlock, who's the founder and CEO of Double Line Capital, threw out a couple quotes earlier this week. I think they relate very much to what we talked about in the video today. The first one he said is, negative rates are really bad. It's going to backfire like an old Model T. And he continues on, we don't want negative interest rates. It would send banks crashing and stock markets tumbling. And while I completely agree with Jeff, it may already be too late. You know, we are moving down this path. So nonetheless, to Jeff, Golden Gong. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Graham.
See you next week.